Good morning. Welcome to the Brew. It's Thursday. That means it's Traders Workshop Day. And today we're talking bonds. James Bond. So stay tuned for this discussion. Good morning, gents. How are you?
What's going on, Lex? How you doing?
I'm doing well. I dress like James Bond, except he would never wear this color tie. It would be black, and it would be much larger than this.
You also wouldn't be wearing it with a T-shirt.
Yeah, he probably wouldn't either. That's true.
Martini too.
Pretty cool jacket, though, right, Mark?
Absolutely. Where's the martini?
It's in a coffee cup this morning, so.
I think you're closer to Pee Wee Herman than you are to James Bond.
Wow, that's what my wife says. You're like Pee Wee Herman. I'm like, Jesus. Okay, let's get busy. Let's do this. I want to get into the bond discussion, but let's have a look at Volland and then Harvested. First Volland, let's look at some key levels with where I think you like Vana the most, but I'll just say gamma clusters and it'll cover everything. I was thinking about you, Jason. Do you want to share the screen right now?
Yeah, you could share the screen. I'm a little bit scared that you were thinking of me, but okay.
No, I was thinking about you because I thought you said 4,300 was a critical level. Maybe it was last week, and we went through 4,300. So I was waiting for that big explosion to the downside, which, we sort of got a little bit. We got it was very nasty, but it kept bouncing around that number, more or less. So is there a new level is question number one. And, what are you seeing out there?
So first of all, yes, there is a new level. When we crashed through 4,300, something that you would notice is implied volatility. You can see it in the VIX or whatever, blew up. I mean, I think it was like 2 days ago when we dropped like 70 points or so. As we crossed 4,300, all of a sudden VIX went up 2 points. So you could say we over VIX. VIX went up a lot more than it should given the SPX move. Right. And that's because all of a sudden put demand went sky high. You can see we're sharing the screen, right?
Yep.
You can see a lot of 4,000 puts were purchased after we crossed through 4,300, which now is negative Vanna. So now 4,000 has become a big strike. You could see all up and down now. Puts are in high demand. Last week, I think we were talking about how historical volatility was at 12 and implied volatility was at like 15, 16. So we were expecting that to converge a little bit. It did not. It actually expanded. A lot more puts were bought. But then yesterday in the afternoon, we saw that there was like some news with the shutdown with the continuing resolution. And we saw a pretty decent vol crunch. Like all of a sudden, implied volatility went down. So it seems like implied volatility is shutdown related, which I don't know why, because all the prior shutdowns, we didn't suffer a massive sell off. It wasn't, things weren't going to flames, right? But so that's kind of the first point is a lot of puts have been bought. And the second point is people make a lot of this JPM seagull that is put on every quarter. And I see online on Twitter, a lot of people saying that the 4210, which is this little stick down here, the 4210 strike is something that can act as a magnet because there's a lot of gamma there. When you talk about Vanna and Charm, this expires tomorrow. So implied volatility tomorrow at that strike will be 0. They'll roll it before then, but when implied volatility is coming down on positive Vanna, that causes dealers to buy, not to sell. Right. So 4210 is actually support. It is not going to act as a magnet. It will probably push price up a little bit.
Okay, let me ask a question. Just for clarity for some of the beginners. You said when Vanna's coming down, I think for the dealers have to buy, not sell. Is that what you just said?
No. So when Vana is positive
and it's coming down,
and implied volatility is going up, then dealers have to sell. When implied
Correct.
volatility is coming down, dealers have to buy.
Okay, so that's why is that? Just so people understand, why is that the case? I know the answer, but I want you to tell us so the folks just learning this can understand it.
Yeah, sure. So let's take this 4210 strike for instance. Okay. You know that JP Morgan has bought those puts as a hedge on a larger position.
Right.
Because they bought it, the market makers have sold it. So they are short those puts.
Okay.
When they are short puts, they are positive delta, right? Which means that they had to sell in order to offset.
Sell stock or some other at something that some short delta to get flat.
Right. But they're not short as much delta as JPM had bought because JPM is long that spot. So it's that kind of offsets a little bit. However, as implied volatility comes down, that put delta, so the dealers are short the put, they're positive delta, that starts eroding down toward zero.
So dealers getting shorter.
On that strike. So because the dealers are getting shorter, they have to buy in order to hedge that position.
That's right. Buy deltas in. Okay, and that typically is the underlying or the like, which causes upward pressure, right?
Yes, that's right.
Perfect. And that's what you're suggesting is going on a little bit with this new strike here.
Well, that's what I'm suggesting will happen with 4210.
Gotcha.
At expiration, implied volatility is always zero. That's like an absolute truth. So this isn't even like an assumption as to what implied volatility will do. This will eventually erode to zero. And that's kind of what's shown by charm. That's the time aspect of this.
Right.
You know, this is on an hourly basis, we will see 60,000 or 60 million of new buying.
Is that a lot?
Every hour.
60 million. I know it's not a lot for Mark. He poofs 60 million every other breath. But for the average Joe, is 60 million a lot of coverage? Is that a big number or a small number?
Per hour. I mean, it's a decent size.
That's a lot.
Yeah.
Okay.
Yeah. So we've calibrated.
I think like 50, 60 million is only on the order of like 10 basis points of what the ES trades in a given day.
Yeah, but we recalculated charm to reflect hourly. So that's 60 million an hour.
Right, but even 60 million an hour, there are only 6 hours in a day. That's still less than 1% of ES volume.
In vol calculations in Black-Scholes, time is calculated as calendar time too, not as trading time, right?
Well, what do you mean? I mean, like most people have different trading day decay ratios than they do non-trading day decay ratios.
Yeah, I mean, you're right. It's not going to be that much. By tomorrow, it'll be a bit, but it's not going to be that much. And that's kind of what one of the points I was going to make is compared to the Vanna across the whole dealer book, this 4210 strike is not very much.
Okay.
I actually think the most interesting part, I mean, it is a naive observation, but like we're almost at like the max pain point for that strategy, right? Like pretty much worst case scenario for hedged equity that like we were at what, like 44 something, 44.50, I think when they reset 3 months ago.
Yep.
And they reset and we literally went right to the long strike. Like they lost their first 5% and they didn't get any of that 5 to 20% buffer.
Yeah. Yeah, you're right.
Interesting. Okay. Cool.
Yeah, the worst possible scenario for them.
Yeah.
But that being said, now 4,000 now has a lot of hedging. It does provide a lot of juice. I mean, now total Vanna is positive by about, I guess you could say 18 billion total between the calls and the puts. And you could see if we do rally, it will get more positive, especially if we rally past 4,300. So I think that if the shutdown stuff resolves, I think we could probably see a bit of a rally.
Yeah, interesting. I was talking to a money manager friend of mine yesterday, as a matter of fact, and he said the same thing. He said he's expecting a pretty healthy bounce shortly. So, for what's that? For what that's worth. Interesting though. Mark, what are you thinking? You want to move to your metric here. We're going to start getting into bonds now. I didn't get
let's talk bonds a little bit. I'll pull it up when we do the zero coupon stuff.
Okay.
That's a good tie-in.
Yeah, gotcha. So let's talk bonds. Okay. So I don't know where to begin. I guess we can begin at the beginning. Why not? I will say this. I am super weak on the fixed income side of the business, right? It was something that just for whatever reason, our business and our market making entity never really got involved in. Mark, were you guys involved in that at all back then in any large capacity?
I know rates because of short stock rebates.
That's it. Me too. Right. And they say, what's that mean? I said, well, when we sold stock in the market maker days against our inventory, at the end of every month, if we were short stock throughout the whole month, we got a check in our account for the interest on that short stock. Right.
Material. It could be like 10% of your P&L in a month.
It could be. Yeah, it was material. So, and we used, there's calculations we did when we had certain positions to assess that number. And real quick, interesting story. I did a spread in my early days of my career. I thought I was a Mr. Smarty Pants. And I did this long stock spread. It was ultimately long stock. It was a dividend kind of play, and I knew I was going to get assigned on some parts of it. I was trying to escape on other parts. And I miscalculated the interest on the long stock, or it might have even been the spread was a debit spread that was gigantic, very little risk, but I had to pay interest on it. And I didn't make that calculation. Right. So when I ultimately paid the interest because I was long it, so I had to pay it, not receive it. It was a massive number. I go, oh my God, I got hammered on this spread because I didn't make that computation. And it was a significant, it wasn't a 6-figure number, but it was a healthy 5-digit number of a loss. So I was like, okay, that's a good education. I won't do that again. And I begged to get out of it. I called the clearing firm. I rolled over in the poop on the driveway and just begged to get out of the trade. And they said, too bad for you. You lose.
I do not know what to say to that. The poop on the driveway. I was like, okay.
The only reason I say that is like my dog rolls in poop. I'm like, who the hell rolls in poop as a strategy? I mean, you can't smell good after that. They do it anyhow. But anyway, that's what it felt like, was rolling in poop.
Well, they're always going to move the rate against you, right? They know what your clearing firm knows what your demand is.
Yeah, exactly. So anyway, let's get into. So you know about as much as I do about bonds. Hopefully, Jason bails us out here. All right. So there's three types of main bonds. There's a treasury bill, there's a treasury note, and there's a treasury bond. And we always say bonds is all inclusive, I think, but there is distinct differences. So a bill is these are debt securities, obviously. All these they're issued by the U.S. government, right? So there's pretty good stability here. So a bill is anything that's less than a year. So it's usually 3, 6, and 12-month sort of entities, correct? Okay. They're typically considered the safest. Why? Not much time to go on these babies. So what could go wrong in a year? Lots of things, but safest. Middle one is the note. So the note is a medium-term debt security. Typically 2, 3, 5, and 10-year sort of durations, maturities. Okay. Obviously, the next step up in terms of riskiness. And finally, the bond, the treasury bonds, T-bonds, those are longer-term debt securities, 20 and 30-year sort of horizons. So far, so good. Any comments there?
Well, the reason we're talking about bonds, right, is because 10 years hit a high. And I think that was like an interesting piece of market, like a 16-year high, I think highest since 2007.
Right.
So like rates are actually getting really interesting, and like bonds are interesting again.
Yeah, exactly. What's the yield on that?
10 years like 4.8. I don't know.
That's significant, right?
Totally.
Wait, is the yield the same as the coupon?
No, the yield depends on the price you pay.
Okay, what's the coupon?
The coupon is fixed, and bonds are issued at par, and they pay a coupon. But then, depending on either how interest rates change or the creditworthiness of the institution changes, the bond can trade more or less than par, which ultimately adjusts the yield to maturity calculation.
Gotcha. So the coupon rate is the fixed interest rate that you've purchased more or less for the bond in question. So if you pay $1,000 with a coupon of 5%, right? You're going to make 5% per year for the life of that bond. Is that correct? That's the coupon on it.
And it's literally called the coupon because bonds were issued in strips and they had little punch things that you could go and redeem and collect your coupon from that security.
That's amazing.
It's like a physical, etymology.
Yeah, so you know more about bonds than you said you did. That's pretty good. I didn't know that one about the little strips. I like that. Very good.
Well, that's why they call the difference between like if you can take the fixed rate component and the floating rate, like that's why it's a strip. So you strip off the coupons.
Okay, I love it. So help me out here. If I buy, I'm just gonna make this up. If I buy a 3-year bond, can I do that? Yeah, whatever, 2-year bond, and I I'm paying par for it, right? And I'm getting my coupon value, whatever that is. Between now and the time it matures, interest rates can do many things. They can go up, they can go down, they stay the same. My investment can make or lose money in that bond, right? Along the way. So I could be technically losing money if I bought a bond with an interest rate now, and interest rates go up. My bond's going to go down. So when interest rates go up, bonds go lower, and vice versa, right? So I could have paper loss on the bond I purchased, even though if I hold it to maturity, I'm still going to get full value for it. So then I don't lose the money. I lose.
And you're still going to get that same interest rate you bought it at.
That's right. And I could forego a better interest rate because interest rates are moving higher, let's say along the term of my purchase. So that's just how it is. And I know that people use bonds in their portfolios, and some have stocks, and they use it more as a kind of a low risk sort of security to offset some of the riskiness they may have in stocks. So they blend these things, right? But with bonds at these levels now, now it makes sense to kind of look at these as a strategy for your portfolio. No,
I mean, if the equity risk premium is 8% over the last 100 years, roughly, and you can get like 4.6% out of a 10-year right now, how much, at what level do you say I'm going with the safe thing?
Yeah. Well, geez, a money market is 5.25% or something like that, right? Thereabouts.
Well, the money market is buying the bills. They're buying the short-term things. And that's kind of being reflected, and they keep cycling in. So if you have a money market and you have it 5%, it's not like you're locking in for 10 years at 4.6%. What you're saying is that you think that the you just want to stay short term because you think that the value of those bonds can go higher.
Okay. Yeah, that's exactly right. So you guys both win the lottery. You split the $800 million lottery. Okay, you won. Oh. Congratulations.
Peace.
Peace. I'm not appearing next week. Leave me alone.
This will be my last episode. Thank you all very much.
I'm splitting my money between Harvested Financial and Ad Deum funds. That's where I'm going to have it invested.
Me too.
And Lex's travel fund. So honestly, how much do you put of that net worth into bonds versus riskier stocks at these levels? I know the answer if we're getting 1%. I mean, it's not worth it.
All right.
But at these levels,
now I got to put on my RIA hat, right?
Yeah, put on your RIA hat. What do you think?
Talking about what your level of needs are when you need.
Well, you don't have needs anymore when you have that kind of money. You don't have needs anymore. There's nothing you can.
Well, I still have 3 kids to go through college.
Yeah, right. You can send the whole neighborhood to college, so don't worry about it.
Yeah, but your needs are denominated in private jet units.
That's true. I mean, you got to put a certain. You got to pick a number that is your lifestyle, right? And put that whatever that sum is at N%, whatever that number is as well. And go on, and that's it. And then the rest, you tell your money manager, say, "Hey, knock yourself out. Keep it sane, but knock yourself out." Right?
Mm-hmm.
I don't know.
You need $1 million a year. You take $20 million, you put it in 4.6%. You're only getting
for 10 years
or whatever.
And you're good.
But, yeah.
Mm-hmm. And the rest we go on black or red. Woo! No, we don't do that. I'm kidding.
The boss, pit boss.
Yeah. So, but now, I guess my point is, I'm being a little silly about it, but my point is that it's a significant decision to make now if you have a reasonable portfolio to consider having some bonds in there because, like you said, Mark, 8% on, over history you get pretty darn close to that with some bonds, some treasuries. It probably makes a little sense to do that, right?
So I'm going to bring the options tie in here and say I think you can do both. I think you can have your cake and eat it too. A little bit of cake and eat a little bit of it. There's no such thing as totally risk free.
Yep.
But we didn't touch on zero coupon bonds, which I think are the most interesting thing to start playing with options.
Can you define those for us? What that means?
So rather than zero coupon, rather than getting an actual coupon every month, you buy the bond for less than it will mature for at the end.
Okay, so you're buying it at a discount.
Correct.
Okay.
And the yield that you get is the appreciation between your purchase price and the $1,000 that you get for every unit at the end of it.
Okay.
So if you buy a 1-year bond for $970 and you get $1,000 at the end, that's roughly a 3% interest rate.
Okay. So, and then what do the zero coupons generally trade in terms of maturity? Are they always shorter term, or do they have zero coupons that are really far out?
That's a really good question. I mostly know of them in the less than 1 year space.
Makes sense, actually, because you're not getting paid interest rate on it, right?
Correct. You're just buying it for less than it'll settle for at the end of the end of the period. I believe they have like 4-week, 13-week, 26, 52 durations. There's a whole calendar to when they get released and sold and whatnot. But there's pretty good access to them, right? Like every week there's a new issuance that you can get on that's pretty accurate rates.
Yep.
But anyway, I like them as a structured product combination with options, where for every $1,000 you want to invest, you put $970 in the zero coupon bond and take that 30 at 3% interest rates and buy calls with it, buy call spreads, buy put spreads, buy butterflies, right? Like you could, in theory, do anything with it really. But, as like a bullish defensive positioning, the bigger rates get, the more premium, the greater the discount you can buy that for. So the more premium you can put towards your call sales, call purchases. And so you can get more and more exposure in equities and still keep that safe capital in there. So for every $1,000 you invested, you're getting $1,000 at the end, and you just have a little bit of an upside kicker that you can downside kicker, however you want to structure it. Yeah,
I like that. So do you do that strategy, with your stuff?
Yeah, absolutely. I have clients that actually go on the bull and bear side, right? That they want safe capital and a downside protection kicker. So we buy out of the money put spreads with it. And then you can do it. I like doing spreads because buying naked options is just kind of expensive. So I think you get a lot better bang for your buck doing spreads with something like this.
So would you buy a downside put spread, like a debit spread in that example? So you're just not getting exposed to the full premium of just the long put versus having a short against it, right?
Exactly. And you can also, you can do 100% capital secured. So, 5% interest rates, you put 950 in it. I'm roughing the math in here, but you can also say, hey, I only want to guarantee 10% of, or 90% of this.
Yeah.
And you have more money that you can put towards the options purchases. So there are a lot of different kind of levers you can move here.
Yep. Jason, what do you got?
So where do you buy your zero coupon bonds? Or even your bonds and notes?
Walmart has them every once in a while. I saw that.
Just a regular.
You have to show your receipt before you leave.
If the way I usually do it is I look them up by QSIP. So if you go on the treasury.gov, you can see the most recent QSIPs, and then you just punch the QSIP into your broker, and you'll get exactly that.
But these zero coupons, they have to trade at the board of trade. There's some exchange they trade at, right?
I believe bonds. I think they're auctioned initially to the bond dealers, and then it's a secondary market that you're buying them, and you're buying them OTC. Although I believe
you can also buy them on Treasury Direct, right?
Dynamic.
Yeah. Would you say Treasury? Yeah, TreasuryDirect.gov.
Yeah.
Yep.
Just gotta get it shipped to your broker dealer.
Yeah.
Okay. Yeah, you can do that too. I believe you can even hold an account at treasury.gov, right? TreasuryDirect.gov. Yeah.
Yeah.
Interesting. Did you have something you want to share, Mark, on the screen?
Yeah, sure. I can show. So I track sort of the rates of the amount of delta you can get from that exposure. And so because I like birds, obviously, this is called the OWL. Sage-wise owl who invests in government securities and purchases call spreads with it. This actually isn't a call spread, but this is the number of vol dollar deltas you get out of a 30 or 360-day zero coupon bond. And so the 360 is looking at a 1-year option, and the 30 is looking at just a 30-day option. And
actually, what are the colors on the screen, Mark? Again, I see it up top. Okay.
What's that second? What's that second y-axis over there? The secondary axis.
So you get a lot fewer deltas. So the 360 is on the right-hand axis, and the 30 is on the left-hand axis. You actually get a lot more deltas in the short term, vol dollar deltas in the short term. And you can obviously also see the variation in the 30-day rate is much more significant than in the 360-day rate or 354-day rate.
Yeah. What are you looking for here, Mark? Are you looking for crossovers? What are we trying to decide? What does this tell us?
I use it almost more like VIX-like in a sense, that it's like a barometer for how much exposure the market is giving you for quote unquote free. And as rates go up, you're getting more exposure. But on the other hand, as if vol is also going up, you're purchasing fewer options. So there are sort of like two dynamics going on here, that it's both like a measure of vol and rates.
Okay. Got it. So this is something that you use in your own money management or whatever we call it.
Yep. Broadly, this strategy is based on this type of what can I get in the options market given the risk-free rate or some capital secured percentage of my portfolio.
Now, so could you use this? You wouldn't use this metric with interest rates at 1 or 2%, right?
Oh, you get practically nothing. Yeah,
you don't get enough. I love the
ironically, that's when the market's going
that's
up
like my
most,
dart.
and you might want your deltas, right? Like,
right. Gotcha. All right, that's interesting. I like it. All right, I gotta go get some bonds, I think.
Oh, well, I was about to ask. So the $1 million question, I guess, is why are rates so high right now? Why do they keep going up?
Well, I mean, I'm going to say the obvious answer. We haven't tamed inflation quite yet.
Because Lex keeps paying through the offer on wine.
That's a good point, too. That's a good point, too.
Well, I think a lot of it, too, I mean, even Jerome Powell said it in the last press conference, is supply. I think the government's spending a ton of money, and the Treasury is trying to pay for it with longer-term treasuries as opposed to shorter-term treasuries. And like we were talking about, the shorter-term treasuries, the money markets tend to scoop up, and so that doesn't have as much of an influence. But I think they're trying to. Is that correct? That's what I've been kind of seeing in the.
I mean, I think it's sound. It's
in the auctions.
Yeah,
it's like a supply demand thing,
right?
And liquidity is getting short at banks, I guess.
Sure does.
So, I mean, it's guesses. I guess that's where we're all blanking out, like where we don't know about bonds is. So what's going on?
Here's a question. Here's a question for you two smarty pantses. Can you see it?
Yeah.
You got it?
Yeah. When the 10-year Treasury yields have historically been half of what they are today, how might this affect nest eggs for those heading into retirement? I mean, overall, I think if you're heading into retirement and you're just holding all your Treasury bonds until maturity, I think the biggest thing you're looking at is inflation, not so much the rates, right? Because if inflation is going higher than your current interest rate, then you
got a negative R bond
losing.
Yeah, you got a negative R bond. That's right.
But I think though that if you're close to retirement, you're probably having shorter term maturities, right? And if you're having shorter term maturities as you inch toward retirement, then as they mature and you're getting a higher rate. So I mean, it can't be that bad. But I think unless you're actually selling the treasuries or you're forced selling them, I think and inflation is somewhat tame and your interest rate is higher than inflation. I think that's those Those are the two big things you're looking at if you're in fixed income.
Right. Do you think China is selling U.S. Treasuries and increasing supply?
You could look that up. You could. Well, I don't know. Well, between now and their SEC submissions or whatever, you can't tell. But they usually. What's the website that was that the FTC or what is that the don't they have like statistics? Fred, I think has like statistics on foreign holdings of treasuries, right? So you could look it up on Fred real quick. I could if you want me to.
Okay.
How long? Are we gonna have the cold close from Lex, and then I can look it up?
No, there's no cold close. It's just like, we got to get to the trading day, right?
We're in it.
What's that? Oh, sorry.
We're in the trading day.
Yeah, we are I keep forgetting we start at 9 now. So okay. No, good discussion on that. That's good stuff. I'm starting to get really interested in the bond market. I got to be honest. If I think I need a couple more ticks, and I'm all in maybe, because I'm gonna win the lotto, so I got to think about this stuff. Mark, you good? Oh, Mark, you're on mute. I think. Are you on mute, Mark?
Oh, yeah, sorry, I put myself on mute. I think it's a very compelling question right now. 4.7%, like pretty good.
Yeah. I think.
Yeah,
pretty good is right. Okay, good deal, boys. You guys have a good rest of the week. Finish Drops of God on Apple Plus or something like that. Really interesting if you're into wine drinking and wine. Loved it. Although I hated reading the subtitles.
So based on, I'm sorry, just to follow up on what we were talking about, I'm looking it up on Fred. Do you want me to share it?
No, please.
Okay, hold on. Let me share this real quick. It's just the.
Okay, you're gonna share a screen.
Yep.
I don't see it yet.
No, there we go.
Okay,
can you see it now?
Yeah, got it. Go ahead. Tell us about it.
So yeah, this is the face value of Treasury securities held. Oh, Fred is the federal. It's a FOMC in St. Louis. Okay. What does Fred stand for? Economic data is ED. Because it's Federal Reserve economic data. I don't know.
Makes sense. I'm gonna go with that.
Yeah,
I'll look it up.
All for this is
time.
free. This is free based on it's part of the Federal Reserve, the Board of Governors. So, but essentially, this is the face value of the foreign official, like international accounts on U.S. Treasuries, and you can see it hasn't really ticked down all that much. This is done weekly, and it hasn't ticked down all that much. September 20th, so that's $3 billion, and it hasn't really moved much. So, yeah, I guess it's not. I guess if China's selling, somebody else is buying.
Yeah, gotcha. Okay, sweeto. All right, boys. Good to see you as always. Have a great weekend. Big college football weekend again. Love that. Bears are. I'm from Chicago. Bears are going to lose again. Although I think they might beat Denver because Denver's so horrible. But who knows? It's like watching two high school.
So are the Bears.
You're right. 100%. Not going to deny it.
Okay, I'm a Giants fan. We have our own support group.
That's right. You guys have a good rest of the week, and we'll see you next week, huh?
Yeah, take it easy.
All right, guys.
Happy trading.
Happy trading.